Hello everyone, this is Jordan. This video is being recorded on the evening of Wednesday, September 4th, 2024. Thank you so much for tuning in. I apologize for not having this video out a bit earlier, but that aside, I'm going to talk about one of my favorite subjects, and that's the 60/40 portfolio and how gold is performing against that portfolio. That's why I call it the most important chart in gold. So it is updated. Now, a lot hasn't happened yet, but maybe we will see some major developments over the coming weeks and months if we have a recession and if the market goes into a bear market. So we'll have to be aware of those possibilities, again, over the coming weeks and months. But let's get into the charts. And I do have a couple of very important observations with the last chart. So here we have my basic chart that I always look at, or I always present, I should say. This is monthly data. Here's gold in nominal terms. Here's gold divided by the 60/40 portfolio. And here we can see the bullish signals, the bullish breakout, confirmation of the new secular bull, 1972, 2002. And again, your gold had a bottom right before. That's why there's the two lines. So you have the bottom for gold, and then you have the confirmation in the breakout in this ratio in favor of gold. Same thing happened here. So again, those signals, those confirmation signals at the beginning of 1972 and the beginning of 2002. Also, you can see gold here. It was below the 40-month moving average, then it surged above it. Here, it got above it in 2001, then it pulled back before surging above it. Here, the last few months, again, this has been going sideways for 2 years, but a couple months ago, it did hold above the 40-month moving average. So only time will tell if holding that support is significant, because if we don't have a recession, this thing can keep going sideways into next year. But this is the clear line for me. This is the clear breakout line. So again, if we see a big move like that, that is what is going to take gold to $4,000 or $5,000, maybe even $6,000 an ounce if that happens within the next year. Then you can see those price levels for gold within the next 2 to 3 years, in my opinion. So again, that it's very important, because we're not going to see gold go. Maybe it can get to 3,000, but we need to see a breakout here for this bull market in gold, this fledgling bull market, really to take shape, be confirmed, and really accelerate and ignite. Those are the words I was looking for. All right, let's get to the next chart. And so this is, so gold against the S&P is 60% of this calculation. And you can see the charts look very similar. This is stronger because in the last couple years, until recently, bonds have been much weaker. So gold has really outperformed the 40%, while against the 60%, it's been weak. I mean, the last couple years has been trending down here, whereas overall it's been trending sideways because of the weakness in bonds. So this is something to keep an eye on. This is an easy thing that anybody can look at with charting software. They don't need to have the data that I have for the 60/40. And so this is something I'll talk about on the next Macro Mondays that I do solo. The yield curve, the uninverting, what that could mean for gold and Fed rate cuts, and will we see a bear market? So more of that, that's for the next Macro Mondays solo video. But this is what we should really keep an eye on, because this will be the driver going forward. If we're going to see a move like that, then we'll have to see strength here first, in my opinion. Now, I love this chart. I didn't look at the inverse of gold against the 60/40, but looking at the, again, this is gold here, monthly data. This is the 60/40 divided by gold. So when this thing goes down, that's bullish for gold. That's the 60/40 portfolio dropping and performing badly against gold. And I actually like this setup better. I think this is a better look than gold against the 60/40. But you really should, when we're evaluating these things as chartists or technicians, you have to look at all different types of charts, and looking at the inverse of things is important. And so we can see, here's that line I'm talking about, where if you get a move down like that, that to me is, that could be the beginning of really strong confirmation. Ultimately, if you see this plunge below this support here, I mean, that kind of plunge, that's when you're looking at 5,000, 6,000 gold. I think in the next couple years, like if you get this kind of a move, that's where the market could go. But who knows? It could break below this line and then maybe go sideways for a year or so, and then the move gets delayed. But I'm just talking out loud as far as the possibilities. Okay, last chart. So a couple important things I want to mention here. So here we have the stock market. Here we have gold. Here we have the gold stocks. This is the Barron's Gold Mining Index, of course. And this is gold against the 60-40. And I talk about this fear of the 2008 Boogeyman, and that fear is very prevalent about, if we have a bear market in stocks or the stock market recession, gold's going to go down a lot. The gold stocks are going to crash, etc. But I don't see that happening. I mean, there's multiple reasons, but I think I can clarify that with this chart. And so here's what I'm getting at. Historically, there are a couple of periods when precious metals diverged from a bear market in the stock market, in common stocks. That was 1972 and 1973. And that negative correlation actually continued from 72 all the way through 77, I think, into 78. But also from 2000 to 2002. So in looking at gold against the 60-40, that adds a lot of context. Here we can see, so here's the stock, here's what I'm talking about. You have this decline here, 73 to 74, or the end of 72 into 74. And then, of course, you have 2000 to 2002. So here, 73 to 74, you had the huge move in gold, also in silver, but also in gold stocks. So gold stocks also made a big move during this period. And this call it a negative correlation or, a divergence as far as precious metals diverging from the bear market here, that occurred right after we got this really bullish signal. This signal was confirmation of a new secular bull market in gold and precious metals. And we saw the same thing here. I mean, the timing was a little different because gold stocks bottomed ahead of gold. Gold stocks bottomed in late 2000. They trended up through almost the majority of this bear market here. And gold had, if you're looking at the weekly, it double bottomed in early 2001. But so we can see bear market, gold up, gold stocks way up, and gold against the 60-40, bottom here in 2001, started trending up. You got the confirmation signal here at the, it started at the very end of 01 into 2002. If we think about where we are here and now, we are getting close to another confirmation signal. While we get a move like that. Now, people, it's important to understand this type of move, this is only going to happen when we have a bear market in stocks. This type of move. And why was there such a divergence? Like, why were precious metals here and here able to negatively diverge and rise during these bear markets? Well, it was because precious metals in those cases, and again, look at what happened here and here. Precious metals were at the beginning, or slightly after the beginning in this case, of a new secular bull market. And so what this chart reinforces, and where we are here and now, is that investment capital has been going into stocks and other assets and not precious metals. I mean, this is really important to understand. And so we're at the beginning of a new secular trend. And so all the money, or the majority of the money, is in the stock market. It's in the S&P 500. Retail money, professionals, they're not invested in gold and precious metals. So when there's a bear market, what happens, as what happened here and here, is that money is selling out of the S&P and then going into precious metals, as we saw here and here. And so there isn't, when the bear market happens, there isn't enough money in precious metals for them to have this huge move down. Now, certainly, if we get this bear market in the S&P, we get a recession, you at point, if it lasts a year or whatever, I mean, the gold stocks and gold, they'll have pullbacks, but the primary trend is going to be higher, as it was here and here. And so all these things are aligning. And so in regards to 2008, if we look at 2008, where we are here and here, gold and gold stocks were already going up for 7 years at that point. There was tons of money already invested in that sector. And so that's why they had a big move down. And that didn't happen until gold had already gone up, I think, almost 4x. This move here, this was after gold went from 35 to 200. That's like, what, 6x? So gold having the big leg down here, you know, the big crash or whatever you want to call it, the big correction, that is not going to happen until, you know, I don't know. My guess would be 4 or 5 years, or the end of this decade. So what I'm looking for is a new secular bull market to be confirmed, and then gold should rise, or the secular bull should last for another decade. So if it goes from 24 into 34, you could have that big crash, that big 40% decline, 29 or 30, 20, 29, 20, something like that. You're not going to have that at the beginning of a new secular bull when you're just getting this signal, because there's not enough money. Look at GLD and the flows and all of that. I know I'm babbling on here and the video's gone way too long, but these are just important thoughts on this that I want to get out. So don't worry about a recession and bear market if you're in precious metals like I am. That is what we need to really get this thing flying. That's it for the video. Let me know what you think. Leave a comment. I'll talk to you guys again on Friday for the weekly update.